So Stu, you wrote this very provocative blog post the other day where you basically wrote back and said, look, when I was in Little League, we didn't get an ice cream just for losing. You actually had to win before you got some success. And you say that when you look out at the business world, lots and lots of people today are just simply congratulated for trying.
I think that's true. I congratulate every entrepreneur for taking the risk and actually starting something, because it takes such intestinal fortitude to leave a big company job and start something from scratch and go against all odds and create something. But the truth of the matter is, not all of those companies should be started, and not all of those companies, in fact, a relatively small subsector of those companies should be funded, and particularly funded by venture capitalists.
And you've dealt with a lot of successful companies over the years. You've probably watched thousands more that have failed. Do you feel like the folks who ultimately are going to succeed have a sense of that they shouldn't just simply be rewarded for the fortitude, or that that's not all there is, that they actually need to deliver after that?
Well, I think you can be psychically rewarded in that you're starting something and it's good for you. But the truth of the matter is, in the end, companies either work or they don't work. And if they work, you're making money, you're adding value to society, you're creating either a product or a service which is helping people, and that's adding real value. If you have a product that doesn't work and a company that fails, you're causing a lot of pain. You're losing either your money, you're losing your investors' money, you're wasting your time, you're putting your family at risk. So on the one hand, I'm a little bit torn, because I'm impressed by every entrepreneur that becomes an entrepreneur. And I love the fact that every entrepreneur puts everything on the line to create something from nothing. But I also know that if it turns out unsuccessfully, it's a very bad thing. So certain people should not be entrepreneurs. I guess in the end, what I'm saying is, certain people are entrepreneurs. They have the spirit, the ability, the judgment, the sort of what some people call the rat-like cunning to create something out of nothing and get something done. And others just shouldn't. They get pushed into being an entrepreneur because either they lost their job or they think it's cool. I remember back in 1999, you had all these people leaving IBM and these very large companies to go work for startups. And they were not startup people. And they'd come in and saying, well, I was earning $225,000 as an X large company. Now I'd like you to pay me $225,000 plus the equity. And by the way, I want there to be no risk. And it just doesn't work that way. It's all risk and reward. When you take the risk, and if it works out, you get the greater reward. But the risk also has a downside, which is what the end of the first bubble really showed to people.
And I remember that just crystal clearly, of people saying, but no, how about the small companies? How are they going to get funded again, and so forth? And you realize that the true entrepreneurs are going to power through that, as they did in the bust. But so when you look at somebody who is going to succeed, or you're evaluating entrepreneurs, some of them always sound incredibly grandiose, making these great claims. Sometimes that's very successful. Others tend to be total realists, but they have a hard time selling things. I mean, is there a consistent theme that you see in the type of entrepreneurs that you're talking about, the people that actually should and do have what it takes to do this?
I would say it's what I look for in both entrepreneurs and in co-investors is what I like to say is no naivete, right? No naivete also has something to do with judgment. Right? So they're not naive about the business they're going to go into. They're not naive about how much money it's going to take. They're not naive about how hard it is to build. They're not naive about where you're going to start it and what it's actually going to take to get from absolute startup to large success, and the risk inherent in that. Fundamentally, usually people that have done it before have a lot less naivete about doing it again, and those are the ones that are really a pleasure to fund. When you have to teach somebody, and teaching on your dollar, on your dime, is very painful, and it can be very, very expensive as well.
And do you find that these entrepreneurs have the same sense of realism with you and with their employees? Or when they go back to the shop and they talk to the employees about whipping them up and the chances of success, are they again as realistic in that environment as they are with you?
Absolutely not. To be a good entrepreneur, you have to force of will things through, right? To create something from nothing, you have to push through a wall and get something done. And a few things are true. In startup companies, there's huge risks that are being taken with customers, and there's huge risk, in effect, with capital, because you're always running very, very lean. You're running sort of to the edge. When you fund a round of capital, right, that round is supposed to take you to the next valuation point. And the closer you get to being out of money, theoretically, the greater valuation you're creating. And if you try and raise money too far away from that valuation point, then you're not going to have a step up or maybe a down round, so you don't want to do that. But if you get too close to it, a lot of unsystematic things can cause the timing to get put off. And the closer you get to being out of money, the more risky it is for your company. And you're not going to go back to your company and say, you know what, guys, I decided I'm going to put all of your jobs at risk and wait an extra month until I start fundraising because I think I can get a slightly higher valuation. You have to make judgment calls, and you have to go back to your company. You have to be realistic. You have to tell your company when things are working and when things aren't working. But certain things don't need to be in their purview, right? The fact that if you have high confidence that you are going to raise that amount of money, and that you know that you'll be able to fund that company going forward, you don't have to be so clear on the company and explain to them specifically what you're doing with the cash and why. You're the executive, you're making the decisions. You're in effect shepherding over these people. It is your responsibility to make sure that they stay employed and create value and do the right things. You don't need to needlessly worry about. You don't need to make them needlessly worry about things that you're supposed to be handling.